So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar together with Admirals. Today, it's Friday. It's the 14th of April, 2023. And I was just scrolling here through my news feed because I just realized that I haven't yet checked how the retail sales numbers were released several minutes earlier. So I just see that they came in below expectations. I already saw that some expectations, so there were some numbers. I checked in the morning with different sources, and they were already very skeptical if these numbers could be printed at 0.4% month on month. So I said that probably it's minus 0.9%. Month on month, and now it's minus 1%. And so cooling down in the overall economy in the US, which is very interesting. It's also given the topic we have today. So we're talking about inflation, but you will quickly see that it's not just about inflation right now. It's also about the overall cool down in the US economy. No big surprise, at least for us. So we made this a topic for several months now, I think, here. I have to smile a little because that the US is headed into a recession. That was something you could have seen coming if you just saw the inversion of the 2- and 10-year US yields. For example, if you saw last year's around 12 months ago, when we saw back-to-back negative GDP prints, and thus bringing us to the classic definition from, I think it's Harvard Business School, if I'm not mistaken. If you Google it, what's the definition of a recession? And then the White House started to somehow define it in a different way. And now, finally, that was the Fed minutes on Wednesday. They admit, yes, we are potentially headed for an economic downturn and headed for a recession, which is bad because we have inflation, and that means that, or we have elevated inflation. It's sure we have inflation, but elevated inflation numbers. Still, they are cooling down already, but I'm sure if they are cooling down or coming down fast enough to justify a more dovish approach from the Fed then to cut rates. But if retail sales, which is considered to be the backbone of the US economy, so I'm not really sure, but I think it's something like 35% or so of the GDP. If retail sales coming in weaker than expected, while inflation stays elevated, chances increase that there will be rather sooner than later, probably already starting in the second half of the year, rate cuts, which means we are potentially headed into something we refer to as stagflation. So no economic growth, so stagnation, while on the other hand, we have still elevated compared to the target rate, inflation target, which is around 2% from the Fed. So long thing short, very interesting topic. And then the question we have, I mean, it's always interesting to look at it from a theoretical perspective. And this is also what we want to do today, again, with inflation and what it is and why it's of importance. But I think what's more important for us as traders, but also for probably investors, is what we can make out of this from a trading perspective. And I came across something earlier this week, in fact, from the sentiment perspective, from big speculators, so market participants who are playing a very significant role in the market and are so big in terms of their positioning that they have to report their positions to the CFTC. That's something we call or refer to as commitment of traders report. It's a very, very important number, in fact, or respectively, a very important component if you want to have an idea on what the market is betting on right now. And you will be surprised to see what I found out. And if you ever wondered where bullishness should come from, well, it's probably because there are some market participants being forced heavily to cover their short bets. And why this is, again, this is something we want to look into today. Before we start, let me just share my screen here. So it was a quite long introduction. If you watch the recording now on YouTube and you liked so far what you saw, respectively what you will see in the upcoming minutes, then please subscribe to the YouTube channel, set a reminder that you don't miss any of the videos which we are producing here for you. And if you have comments, questions, whatever, post them below. I'd really like to answer them. And so today, the overall topic is inflation, but we want to play it a little wider, let's say, and also give an idea on where the market is potentially headed based on that. Also, in terms of gold, that leaves us or brings us already to the risk disclaimer. Very important. Everything I present to you here are my thoughts on how I see the current situation. If I formulate a trading setup or a trading idea and you think, well, this sounds great, I want to play it that way, I want to trade it that way, please make sure that you understand that if trading, especially leverage products, involves risks. Risks which makes these products not suitable for all investors, respectively traders. So please make sure you read the risk disclaimer carefully, you understand all risks involved, and if you start trading, especially with real money, that you are fully responsible for all gains, great, but also for all losses which you might face if I'm wrong with my thoughts. So everything I present to you here today is for educational purposes only. So please don't misunderstand that. Read the risk disclaimer carefully. Check out the website admiralmarkets.com for further infos, especially the risk disclaimer. And Admiral Markets, the broker behind these webinars, Admirals, after the rebranding, so admiralmarkets.com is the website, but then there was a rebranding taking place, and now we are referring to Admirals, especially due to the fact that we are also now very focused on investing. And well, fully regulated broker, first of all, but in addition to that, also a broker which is considered to be probably one of the leaders in the CFD and FX industry due to their very, very competitive offering, especially when it comes to DAX trading. So I'm located in Berlin, in Germany, for example, and usually when you ask a trader who they think is a great broker in terms of CFD brokerage, respectively DAX trading, usually Admirals is minimum among the top three, if not the first mentioned name in this space. And so all details again, admiralmarkets.com for further information. One world, one broker, but our topic today is inflation and what inflation is, what we currently witnessed in the market, what this means, and also what we can make out of this from a trading perspective. So first of all, what is inflation? In economics, inflation is generally speaking, an increase in the prices of goods and services in an economy. So rising prices usually mean rising inflation. This is also a number which is usually referred to as consumer price index, CPI, in short. So, and roughly speaking, when general prices increase or price levels rise, then each unit of a currency buys fewer goods and services. And that being said, inflation erodes the purchasing power of a bond's futures cash flow. That means usually what you expect if inflation rises, you also expect yields to rise because to make sure that market participants still invest in bonds and thus loan out money to some extent to economies like the US or something. The central bank hikes rates. It's also with the attempt or in an attempt to break down, let me just check here. They also hike rates in an attempt to bring inflation lower or down again. That's very interesting because we will just, I just realized that I haven't prepared this, but I will show you a comment from a very successful trader, investor, probably one of the greatest of all time. His name is Stanley Druckenmiller. He's one of the hedge traders, was one of the head traders of the Quantum Fund. You probably have heard about this, the hedge fund, Quantum Fund. That was George Soros' hedge fund, which broke the Bank of England in 1992. And the head trader back then at this trading desk was Stanley Druckenmiller. He's still a very successful trader, investor. I think he's right now, well, several years already, running a family office, managing billions of US dollars, averaging crazy returns year over year. So a guy who's not just worth listening to when it comes to trading advice, and what to look at when trading the markets, but also in addition to that, also if he gives an well, how can I say that? An outlook or idea around where we're currently in the, let's say, economic cycle. Well, this is a guy you should definitely listen to. It's a guy you should keep an you should keep the mouth shut and just listen to what this guy has to say. Completely different to what you might get from the mainstream media or in CNBC or whatever. And so coming back now to inflation. Again, we will point this out. Very important. We usually say that the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand higher yields to compensate for the inflation risks. So that being said, it's very interesting because we've seen the hiking cycle of the Fed, which might have peaked. We don't yet know, but which might have peaked, and which already resulted in a quite impressive bear market over the course of the year of 2022. So if you look at the Nasdaq, for example, if you see how markets came down, that was mainly due to the very restrictive monetary policy path the Fed followed here to bring inflation back down. So as you can see here, this is a chart I snapshotted and I overlaid it obviously here with another chart. So in blue, you have inflation, and in black, in the black dotted line, you have producer prices. Both numbers were just released. So inflation numbers came in on Wednesday, and one day later, yesterday, we saw producer prices being published. And what we see here is that both are obviously positively correlated with each other. Why is that? Well, if you're producing a good, if you're an entrepreneur, whatever, and you're producing a good and you have higher costs to produce the good, to keep your gross margin, or to stay profitable in your business, well, you have to forward the higher cost of producing the good over to the consumer. Which is, by the way, one of the reasons why, for example, equities, stocks are usually considered an inflation hedge. So that might surprise you because, say, well, that doesn't fit the formula, right? Because you just said that we were in a bear market after inflation rose, and then the Fed hiked interest rates, and thus we saw a bear market. That's true, but given we don't dig too deep into this topic right now. But what you can usually see is that with an increase in prices, you also see an increase when it comes to the earnings per share, or the earnings you make, the money you make with your investment, which is kind of an inflation hedge, because the higher the prices, the higher the earnings you will receive per share out of the business the company XYZ is doing here. But coming back to this chart, so you can already see both lines are declining at a very fast pace right now, and are obviously coming lower. And the thing is, that was something which we could have seen coming already. And I think most of the attendees here in this webinar series have seen that coming, because as we will see in a later chart, there's a strong correlation. In fact, we have it here. There's a strong correlation, obviously, when it comes to the subcomponent in the ISM manufacturing, but also in the non-manufacturing. And there's a subcomponent which is not just employment, which is very interesting when we look at non-farm payrolls, but also when looking at the paid prices component. And this is exactly what you get to see here. So this is the paid prices component now in blue, while you have the inflation rate in the black dotted line now. And as you can see here, that was in June 2020, if I'm not mistaken. We peaked out there above 9%, and then continuously traded lower from there and accelerated on the downside. And I remember that back in last summer, I was already making this a topic. I said, well, you can see that paid prices in the manufacturing sector in this context here this is kind of an indication of where inflation is headed, and inflation follows the paid prices component with a delay. And once we roll over in the paid price component here, when it comes to the manufacturing sector, again, this is also true for the non-manufacturing paid prices component, but we're focusing here on the manufacturing side. What you usually will see is that inflation will follow, even though with a delay, with a lag. And this is exactly what we get to see here. So when over the course of, especially here, we started to decelerate, let's say, in the second half of the year, it was clear that we are now potentially headed lower when it comes to inflation. So now the question is, what does this mean? I mean, if we're headed lower inflation-wise, is this positive or is this negative for equities especially? Well, this depends massively on the monetary policy path the central bank, in this case, the Fed, is following. So if we are here seeing a very restrictive monetary policy path and rate hikes, this is usually then something which will result in a drop lower in equities. So the interesting thing now is, again, this was in June 2022. And now what we will do, let's have a look here at the S&P 500. Today, we want to focus on the S&P 500. We won't focus on the NASDAQ. That's why we do this. This will become clear in a few minutes when I show you the sentiment and here the commitment of traders report. But let me just here show you when, oh, I'm sorry, I have to change this. I can't really see it. Let me just do it that way probably. So there we go. So numbers were released. That was here, somewhere here. I'm not really sure. I think it was released here, the 10th, 13th, somewhere here. I think so. Was the 10th? Yeah, it was out. Yes, it was the 10th. I remember that day. Why do I remember that? Because we saw a consolidation before the release. And then, surprisingly, we broke lower out of this consolidation already the Thursday before, and then continued trading aggressively lower the following days. Closed very weak for the week itself, and then gapped lower on Monday and continued trading lower. But it was around the lows, and then we saw a rally up here into the 200 SMA, which you can see in blue, into August. And then from there, we pushed again lower. So the interesting thing here was that now you might say, okay, now we start to see clearer when looking here at the presentation once again, because as you can see here, so that was around the peak and we were already around the lows for the year. So it's not that we just turned around and traded higher from here, but we saw another dip lower over the course then of the year. But again, that was around the level which we saw. It was a 3,880 around. And then the lows were marked around 10% lower than that. But we didn't really significantly trade lower. That was completely different when looking, for example, here from where we came at the beginning of the year, and then we dropped and we started the bear market around 4,800 and traded lower here for the year of something like 25% or so. And as you can see, the market played the future to some extent. So it anticipated what will happen in the future. There will be a cool down in inflation, and then you see the reaction in the market. In this case, we sharply bounced higher, traded lower again, and then when the market realized, okay, we are really peaking out here. So inflation obviously is now following the paid prices component in the ISM manufacturing. Well, obviously, this was the peak in inflation, and then we are headed lower. And once the market realized that, that was the starting point here of the current bullish environment in which we find ourselves. So this is the first thing, what we are currently looking at here, right now. So now I want to show you something. First of all, before I forget this, Druckenmiller inflation. Let me just Google that and see. So that's interesting. So it was already in September. Let me just see it here. That's a German article. I don't know. That's unfortunate. I'm not well prepared here because it just crossed my mind. So that was in yes. Yeah, that was in June. That was already in June, and it's a Bloomberg article, so you have to pay for that. Okay, let me just see. We use this one here. I'm sorry. That's unfortunate. But well, around June, August, September, somewhere there, around within such an interview, Druckenmiller said that once inflation has broke above 5% in the past, and he's obviously referring to a quite short period of time, probably 50 years, if at all, because that hasn't happened that often. We can have a look here at the max, and then how many times in the past? Okay, well, more often than I thought, right, to be honest, especially following probably past World War II and probably following Bretton Woods. That was around, 1970s, something like that, 50 years. It's probably good. What he said was, once inflation breached 5% and traded above that in the past, to bring inflation down to the target rate of 2% from the Fed had to hike rates above inflation. So if inflation is, let's say, 7%, the Fed had to hike rates to above, in this case, 7%. We can make this is very great here because trading economics delivers an opportunity for us to overlay this inflation here with interest rates. Let me just see it here. So, and there, can you see that? Well, that's a little unfortunate. Oh, well, no, it's not very good. It's not that good. Let me change 25 minutes, probably. Oh, that's probably better. Yeah, that's not bad. That's not bad. Even though it's still not 100% visible, but looking back, for example, here, 2000, for example, probably here. No, that was around the once the great financial crisis hit. It's a little unfortunate because you can see here. So this is inflation, and here you have the interest rate levels. And as you can see here, so this is some 500 basis points difference. But if you carefully watch, you will see that this was in fact what happened, for example, in the early 1980s with Paul Volcker, hiking rates above the inflation back then aggressively, and then bringing inflation down, and after that cutting aggressively, and everything else followed, to be honest. But the thing is that this is a very, very interesting remark, because this is exactly the remark I remember right now when looking at the inflation numbers, which were just released here, with 5% now on Wednesday. Why do I say that? Well, 5%, you have seen that number, because if you look at the Fed Watch tool, you can see that this is the current target rate. So 475, 500 basis points, this is where the Fed is standing right now. And the market is expecting in May or in June, 25 basis points, but this is everything the Fed will in fact deliver, let's say. So in terms of hikes, and then they are done. And this is especially what the futures market is telling you here with the Fed Watch tool. So if you go from June 2023 to December 2023, you can see that the market is here with a likelihood of over 50% already pricing in rate cuts from there, because of the slowdown in the overall economy, which we're currently witnessing, for example, looking at the retail sales numbers, which were just released. But also given the fact that inflation has now come down to a point where we can say this is like the Fed is back in control to some extent. They hiked rates to a level where inflation can be found right now, which makes it likelier that we will bring down inflation to the 2% level. And this is interesting now, because let's have a look here at the next slide I prepared. And by the way, before I continue talking, 1 second, please, I have to just make sure that I have all data available here for trading the US markets today. So you probably have seen that the JPM came out with very, very strong numbers and a very, very strong guidance, I think, too, if I'm not mistaken, or if I can call this a guidance, let's say. And I have to just make sure that I have all data available so that I can document the trading afterwards in a very great, in a good way, so that I can make sure that I with the documentation can make it better next time, let's say. So have everything available in this regard. But now coming back to the presentation. So what do we have here? So this is a snapshot from the Fed Watch tool I just showed to you. So this is obviously for free. It's available. Let me just probably share the link here so that you can check it out yourself. I call it Fed Watch tool. And now coming back to the presentation, I have another graphic here. This is also available for free. I haven't prepared it now. This is from the economic projections from the Fed from, I think it was December. I think that was December. I haven't updated it with the March, but this one hasn't changed dramatically here. So what you can see here is, what do the Fed members think where rates will be at the end of the year 2023? And as you can see here, it's 500 to 525 basis points. And this is interesting because now you can see inflation has already come down to the level where rates are right now, slightly above that, 25 basis points higher is the Fed expecting rates with a majority to be at the end of the year. But inflation is already at this level while the economy is cooling down dramatically. What does this mean? Well, it means nothing more than that obviously we can say target reached. So the Fed doesn't need to hike rates aggressively anymore. Well, given the fact where let's assume that we don't see another a pickup in inflation in the upcoming months, for example, due to the production cut from the OPEC plus several weeks ago, 2 weeks ago or something, which come completely as a surprise, for example. But given that, let's assume that inflation stays at 5%, is probably coming in lower in the upcoming months, then this is probably too restrictive. That means that here, this dot plot can be expected to come in lower. So the rates at the end of the year should be expected to be lower than what the Fed is already here considering to be how can I say that? Necessary, probably, to have rates to bring inflation down, and then also supporting the overall economy. And why do I emphasize all this? And what does this mean when looking at the market right now? So as you can see already, the market started already seeing the end in sight, let's say, in terms of rate hikes. When we bottomed out, that was in October 2022. We bottomed out here. It was an aggressive flush lower, and then we took off from there. That was a massive reversal. I think one of the most aggressive reversals of all time, and back into minimum the 1950s. I have to look it up now, but I'm sure that was one of the most bullish reversal days ever. And we took off from there. So right now, well, certainly there's sharper bounds, and we have seen that, for example, here. That was in December, for example. That was a surprise. We didn't make it back off 200 SMA, but finally we broke higher now. And as you can see here, this is the region around the yearly highs. And so the interesting thing is that given all the information we have right now, we could say, okay, well, inflation is coming in lower. The Fed should be expected to lower its guidance in terms of future rate hikes, respectively. It will be rate cuts more likely. But everything you just presented to us is something we know already. So it should be priced in, right? Because this is something everyone can find out himself. And if we can talk about it right here as retail traders, well, big speculators, big players in the market, they have this available, and they already know this and are already positioned for that. So it should come completely different, right? So the market is probably not making higher highs. I'm not sure, because the positioning tells a very different story. And this is now where the commitment of traders report comes into play. So again, I prepared this here, and this is, by the way, also available for free. Let me just share it. And COT, it's Commitment of Traders Report, and it's for the S&P 500. We can, by the way, just go back, and then you have an overview of all other markets. So it's not just the S&P. You can also have a look at the NASDAQ and so on and so forth. You have an overview here of gold, cotton, orange juice, whatever. But we want to have a look here at the S&P 500. And why do we want to have a look at the S&P 500? Because we are interested now in how are big traders positioned right now. What are they betting on? That's what we are interested in. And are they probably caught off guard, let's say? I think the answer to this is yes, they rather sooner or later will, because I have trouble to understand how this is possible. But what can we see here? Well, this is obviously a bar chart. And here we have several lines, and we are focusing only on the on this here, because we can also go in more depth, but we only want to have a look here at this green and at this red line. The green line is, in fact, what's of most importance for us and mostly interesting for us. The green line shows us the so-called non-commercials. It's the large speculators consisting of managed money and other reportables. So it's the green line. So this is like big hedge funds, CTAs, commodity trading advisors, and so on and so forth, trading the S&P 500 future, E-mini S&P 500 future, and telling us how they are positioned, because they have to tell us, because they are so big in the market that they need to tell us, and they're forced to report their position to the CFTC, so to the CFTC. that's it. So to the CFTC. And as you can see here, this green line is below zero. So you can see here, right now, it reads minus 321,000. What does this mean? That means that the large speculators reported last week on Friday, as of last week, Tuesday, because there's a delay of three days, they reported that they are short the S&P 500, 320,000 contracts. And now you might say, okay, well, in relation to what? Is this a lot or isn't it? Well, let's have a look here at the last, let's say, 20 years. Okay, so we are going back to 2000. And now have a look here at how many times the market was that aggressively short the market. And as you can see, that was once. That was shortly before the great financial crisis, 2007. And they were right here. But if you then look after that, you can see here, for example, that was in 2011. It was in October or something. We had a similar position of 250,000 minus. That was kind of a sentiment extreme, and we took off from there. And by the way, we took off from there. So what's the big difference here between these two occasions? And you can see this is well, probably here in April 2020. That's probably a next time. That was around COVID. Was slightly higher, the net short position, slightly higher in this case, meaning only 220,000 contracts. But it doesn't happen that often in the past, as you can see here. What's the big difference, especially here with 2007 and here 2011? The big difference was that we had a great financial crisis brewing, and we were within the Fed aggressively hiking rates. So that's something you can see here. Let's overlay this once again. Compare, pick country, United States, and then I'm not even sure if probably we change this. Let's go here to interest rates straight away. And go to the United States. There's probably, oh no, Saudi Arabia is probably not so important for us. So United States, 25 years. So here, as you can see, that was the hiking cycle, 2007, and then they had to aggressively cut rates over the course of 2008 with everything around the great financial crisis. In 2000 and in 2011, we were within the midst of more quantitative easing and more liquidity pouring into the market, in a very similar environment in which we find ourselves right now, with the Fed having already signaled, well, we probably headed into a recession based on the last Fed minutes on Wednesday. And given what we're currently witnessing here, and given the fact that the market has probably the worst behind it, with the big drop in 2022 after the aggressive hiking cycle and inflation coming in quite significantly. And also, now you might say probably, well, there's parallels, no? So like the banking crisis, like what we've seen with Signature, well, respectively with Silicon Valley Bank 1 month earlier. Well, probably there's signs, but right now, and especially how the situation was managed, how well it was managed, probably one might say, it makes the impression as if the Fed, respectively also politics in this case, and in this case, the Ministry of Finance, for example, is prepared for the tensions brewing here in this sector. And given all this and combining this, and that we are about to potentially break out to new highs, well, this position, I think, is very aggressive. So I'm not sure what they're betting on. Probably they were betting on that inflation is potentially not coming in as aggressive as we're currently witnessing. And by the way, it's not just inflation; it's also here producer prices, for example. And probably they were also betting that the Fed has to keep rates at an elevated level for quite an extended period of time. Probably that's the reason. But this bet is potentially turning sour right now. So right now, they're facing trouble because inflation is coming in, and we are at a level right now, inflation rate-wise, which is nearly in the region around where we are currently with the target rates in terms of the interest rate level from the Fed. So they don't need to hike more aggressively, especially when focusing on the overall situation in the economy. And by the way, they want to support the economy. At least I expect the central bank, in this case the Fed, to support the economy. Why? Well, look at the geopolitical tensions we currently facing with the US and China, for example. Just imagine you're now responsible for the politics. You are the White House, and you're in a potential race here with a power like China, who is also attacking to some extent. I would say this was also something sometimes a topic in the past webinars we had here in terms of the US dollar, attacking the US dollar here. So if we put all this together, I see a dovish path from here, with the Fed being followed to support the overall US economy, and probably also having now the room to act more dovish, given that inflation is coming in. So now, just as imagine you're a big player, you're someone who has a position which is as big as 320,000 contracts net short, betting that the Fed potentially has to keep rates at an elevated level. And now you see, well, they probably won't do that. What will you do? Potentially cover your losses, right? Well, what does it mean if you cover the losses? If you're net short, you have to buy back. You have to buy. And we're about to break to new yearly highs here, which means if you wondered where the buyers should come from, it could be it could be a short squeeze, in my opinion. It could be market participants who are forced to buy, given that we are breaking to new highs, and that the overall macro picture is completely changing right now. And that's one of the reasons why I'm currently more bullish on stocks in general. And I expect really here the breakout to happen after what we've witnessed now with the numbers coming in below expectations. To be honest, I was very surprised, in fact, to not have seen. And now we come to the 50-minute chart here. I was surprised to see that we initially saw the pop higher, but didn't make it through. So there was no follow through following the numbers which came in on Wednesday. But we rolled over and closed quite weak. That was not a very good sign. But we now made it back, most likely due to the fact that we are we also saw a massive drop in the PPI, the producer prices. And so my play here right now, right here, is in fact that I want to see, that's also an intraday play. So longer term, probably for investors of interest, break higher to new yearly highs, holding, and also probably in June then, probably it takes some time, and the clear sign from the Fed that they will bring down their dot plot. So, and thus then forcing the market participants to cover their shorts. That's probably the longer picture, and that means that with probably we make this within the first half of the year. So probably at the end of June, we will see another attempt here to break towards 4,300. But for today, the question is, okay, what are we looking for? So this is right now not so positive, let's say, but right here, after it's 10 minutes into the day, probably we go to a 5-minute chart. I would say an open range breakout is potentially of interest for us, 4,152. I could imagine that this, with a break higher, and then when we're looking, for example, at the broader market, let's have a look at the sector ETF, for example. By the way, I could do this for you. Right? No, it doesn't make sense. It doesn't make sense right now. I just have a look here, so we're not getting any information out of this. Let me just see. So Ethereum is going berserk. No. Well, we could now go through how to spot a potential trend day happening. Not sure whether this will happen right now. Signs are not that clear, let's say. But okay, let's keep this out. So if we get to see a breakout higher now, after the first 10 minutes of trading, 50 minutes of trading, break above 4,152, I could imagine, in fact, that we are headed at least into the weekly close for retest of the yearly highs around 4,190, 4,200 probably. So that looks promising. That looks promising and favors the long side. And there's also, given now, if we want to break it lower to stocks, then probably this is also a bullish sign for something like JPM. Let me just have a look here. Also very interesting. So we already touched 138. So breaking above 138 is the break of the highs from the pre-market initial reaction. If we can hold these, well, probably we are headed to 140, probably 142. And so putting all this together, for today, the overall picture looks promising. After an initial pop higher, selling off, closing weak, then producer prices coming lower than expected. We reverse the bearishness of the inflation print, and putting all this together leaves us with a quite bullish picture for equities in general. So longer term, due to the commitment of traders report and market participants potentially being forced out of their short positions, and it's not some theory or something. Well, we know this because they have to report their positioning. So this is like it's an open book. Like we have all the information here, and now we just need to wait until the unwind of this positioning starts, which means buyers coming in because they have to close out their short positions, and this drives us potentially to new yearly highs, and then potentially first target is the August highs around 4,300, 4,350, and shorter term for today. So intraday traders, we want to see a break and hold, as you can see here right now, 4,152. Stop probably below the candle, probably this year. Let me just check. Where's the volume weighted average price? Yeah, volume weighted average price right now is 413 in the spider, which is closely below that. Well, I think, yeah, a low below here, a stop below this candle, 4147 is probably okay. And then, yeah, well, we want to see the momentum continuing and see that we hold higher, that we are now getting to see probably consolidation above the highs, the pre-market highs, and probably tight consolidation. That's a positive sign, probably a reason to add them. And again, overall target here is, why not? Why not going for at least a test for 180, probably for 190 in the hours to come. So That's it. That's it. I hope you enjoyed this webinar. I hope you got something out of it. And please, again, if you watch the recording on YouTube, please remember to subscribe to the YouTube channel, and also leave a thumb up here if you like what you saw. Any comment is highly appreciated. Any questions you might have. And that's it from my end. Happy trading. Watch your stops. Talk to you again next week. And see you soon. Have a nice weekend. Enjoy yourself. Talk to you. Bye-bye.